So asset allocation is considered as the most crucial block of investing. It is said it helps one in minimizing the market volatility. But what does asset allocation contain? Are there different types of strategies for all? If one size can't fit all? To help you get the right answers for all these questions, we have Santosh Navlani, COO of ET Money. Santosh, good evening. Welcome to the show. We've had a lot of discussions around asset allocations, a lot of time, but then let's start with the main purpose for having an asset allocation strategy or for adopting a strategy that involves asset allocation, which is the most crucial need if you want to build your financial portfolio.
Hi, Kavita. Yeah, so we've spoken about asset allocation multiple times, but I think it's a topic which deserves the most important, focus in portfolio construction and management for almost every investor in the country. So let's understand what exactly it means as a recap for many people. On the broad basis, it means that how much I allocate in different asset classes as an investor because different asset classes perform differently at different times. So equity is an asset class, debt is an asset class, gold is an asset class, international equities is an asset class, real estate is an asset class. And all these asset classes, we all know by being observant to observers of all these market prices on daily basis or periodic basis for different assets. We've seen that they don't perform well. All of them don't perform well all the times. Sometimes equity will give you outsized gains. Sometimes debt will protect your portfolio by actually rising while equity and other asset classes are falling. Sometimes gold will come to your rescue, or sometimes real estate will be in upcycle for years together. And hence it is important that you should actually have exposure to all asset classes because one thing we cannot do is having a future eye towards which asset class is going to perform in the future. Now, because we don't know that, it's always better to actually have multiple asset classes in the portfolio, which actually have inverse correlation to each other. What it means is have asset classes which actually are supposed to work differently and not perform at the same times, fall at the same time. So you can have equity and debt as a classic mixture which performs well for most of the people because when equity rises, typically debt doesn't give you good returns. Or when debt gives you good returns, equity is in a downfall. And similarly, you can combine gold, international into the mix and actually improve the risk return equation of your portfolio. And that's what asset allocation does for you. And if you apply it well, I think for long-term investing, it is one of the best ways to give time to your portfolio. And when you give time, compounding follows.
Right. So there is inverse correlation with each other when we talk about asset classes. But then could you also explain what are the triggers that actually impact these asset classes and how are they inversely correlated?
Yeah, so typically we all know equity prices are like, always a more of a future gazing or other things which always perform well in advance of the realities in that sense. So what I mean to say is equity markets will actually start to run up much before the reality changes. So today, if you are noticing that while nothing has changed, only narrative from Fed or no inflation data has changed, earnings have not been impacted. In fact, they've been mixed in the last quarter, but markets actually have run up almost like 12% from their lows and almost about just few percentage points below from the lifetime highs, at least on Nifty and Sensex. So if you keep that in mind, what has happened is market has run up before the news of economy actually really becoming good or attractive or earnings actually increasing. And whereas debt actually performs in a different way when you are actually in a debt mutual fund when you're investing. Typically, what happens when a rising interest rate cycle starts, you actually start to lose some kind of money on your bond prices and your returns get impacted. And typically interest rate rise when there is a froth in the market or markets actually have become excessively valued and because of which inflation coming in the market. So typically when debt performs, it's time for equity not being performing well. When equity performs, debt typically doesn't give you attractive returns. So this is how things have been there, and typically gold becomes a very risk-off scenario where people don't trust what equity is going to give you in next few years or few quarters in that sense, or even debt is not attractive because interest rates are actually falling to support the economy. And gold typically comes in as a more of a saving grace, where it gives you a hedge against inflation, a hedge against equity and debt fall in the portfolio. So typically all these asset classes perform different times. It's rare that all three asset classes will give you positive returns in a given year.
So, Santosh, before I asked you the different types of asset allocation strategies, I want to understand, is this a strategy that you need to adopt when you lay down your financial portfolio the first time, or it's something that you need to keep on adopting? And, as we just discussed, these assets are inversely correlated. So, depending on the market's move, you need to just rebalance your allocation and your exposure.
Both, Kavita. I think you cannot start constructing a portfolio without knowing what kind of asset allocation it should follow. And once you actually build a portfolio, you need to continue to manage it well enough, at least manage the risk part in the portfolio, so that you are able to give time to your portfolio by staying invested and returns follow. So I think it is something which you need to do at both the stages. I think successful investors who actually create market beating returns, the most important aspect they're doing in the life is not buying the best funds or the best stocks. They actually have as allocated well all the time. So I think it's the most crucial aspect while building a portfolio and managing one.
Now let's talk about different asset allocation strategies. Which is the first one that you would like to explain?
Yes, so I think one of the most important. I think when you are looking at this asset allocation, while it sounds very simplistic on the top, that have different exposure allocations to different asset classes, it becomes very difficult because we typically have multiple goals, multiple different horizons in life, different risk appetites to different goals, and maybe risk appetite as individuals as well. So it becomes very difficult thing to actually have one size fits all kind of approach. Hence, I know you should always begin with something more simple in life. If you're not somebody who understands markets or have an advisor to yourself. So one of the most important, or rather most popular one, is, in my opinion, strategic asset allocation, which actually is having a long-term view towards portfolio. If you're investing for next 10 years, 15 years, 20 years goals in life, typically it is suited that you have a very aggressive allocation towards equities, like an 80-20, 70-30, or like a 90-10 in favor of equities. And once you decide that this is your asset allocation for next kind of significant portion of the 10-year period or 15-year period, you ensure that you're not deviating too much from it. So for example, you have a SIP of 10,000 rupees starting for a financial goal, and 8,000 is going towards equity, 2,000 going towards debt. And because of market fluctuations, as well as additional money which will keep every month into your portfolio, what will happen after like 15 to 18 to 2 year period, 18 month to 2 year period, you would notice that the deviation between like the equity and debt allocation doesn't look like 80-20 anymore. It looks like 84-16, or it looks 85-15, or maybe 75-25. Then it may be a good time to just go and rebalance portfolio, come back to 80-20, which is your strategic allocation. Until the time you actually are comfortable taking risk in your portfolio, have that 80-20 allocation maintained, relook at it every 6 months, every 1 year, every 15 months, as it's comfortable to you, and ensure that you're following that approach throughout. I think is one of the most important thing that most people can follow, difficult and very easy to kind of construct and maintain, is how I put it. And it may have its disadvantages, simply because what happens, you are actually doing 80-20 kind of thing at every market level, even if it is high, even if it is low. Sometimes it is better to actually buy more when asset has fallen a lot. So sometimes it may be a chance to go 100 in equity because market has become very attractive, like March 2020 kind of scenario, and you miss out on strategic asset allocation. And maybe you can overcome this limitation by different kind of asset allocation strategies as you progress as an investor.
Balancing is the key when you talk about strategic asset allocation. But Santosh, what is constant weighing asset allocation? Is it something that an investor really need to keep an eye open all the time and keep tracking?
Yeah, so if you, depending on the studies that you look at as an investor, you probably will notice a lot of people recommend that follow a simple allocation of one third, one third, one third. into equity, debt, and gold, maybe 25%, 25%, 25, 25 in equity, debt, international equities, and gold, and continue maintaining that. In that case, what happens is you are not kind of missing out any kind of specific asset class, and because you are ensuring that at every point of time you are having 25, 25 in each asset class, what happens is you periodically start booking profits in the asset class which has risen too much in a really quick time, and you are basically averaging out faster in an asset class which has fallen more today. So let's take an example. If there was a March 2020 scenario, you would have possibly looked at a case where equities would have corrected significantly from 25 to 20, and you would have averaged out more by buying equities. And then in month of July, you would have seen your gold has risen too much, and then possibly you would have booked profits in gold and put it into debt or equity depending on the case. What happens is a constant weighing asset allocation allows you to really have a very disciplined approach towards booking profits in the portfolio and buying the kind of loser and averaging it on the selling the winner and the buying out the loser more, and over a period of time you make good returns. There are big proponents of constant weighted asset allocation models as well, and I think it works pretty well for many people if one is not in a return chasing mode all the time.
All right. Now, but then as we see, the investor's risk profile keeps changing as per their age. So when we talk about asset allocation strategy, is there any age-specific strategy that one can adopt?
Yeah, so I think it is as simple as strategic asset allocation, as how I put it, Kavita. Many people actually make it oversimplistic and say that do it 100 minus your age, and that's your equity allocation. So if you're 30-year-old, do 17 equity and 13 debt. If you are 40-year-old, make 16 equity and 14 debt. I think it becomes too oversimplistic, but as I said, sometimes, because complexity doesn't work for a lot of people, keeping it simple may just be a good rescue. Age-based asset allocation is probably the simplest one you can have. I'm not sure whether having a decadal approach to it works fine or not. Maybe you'll probably need to keep in like every 2 year look at your asset allocation. So if you're 32-year-old,
battery is low. Please charge as soon as possible.
If you're 32-year-old, then it becomes you probably increase your debt allocation by 2 percentage points and reduce equity, and keep on doing that as you become more old. Again, it will same thing. It will probably allow you to book profits in equity at regular intervals, and cut down the risk in the portfolio as you age further in life.
Is an investors like a tactical asset allocation?
Yeah, so tactical is one of the possibly more nuanced asset allocation strategy, Kavita. I'm not sure how many retail investors can actually follow, given that many of us don't have full-time access to a lot of data. We basically have our own jobs to look after or business to look after. So what it works is basically you actually are very, very timing oriented person, and you are good at understanding that market has actually become such that it is likely to bounce off very quickly from these levels. So I'll increase my allocation towards equity when by looking at technicals, looking at fundamentals, looking at valuations, all things together, and take on very, very tactical calls that I should be booking profits as markets rises and becomes overvalued, and keep booking move that money into debt at the same point of time, and again come back to equity when market looks attractive or looks like a very strong technical trend or any kind of forward-looking behaviors that market participants are expecting or exhibiting by buying more of equities. So it becomes more of timing, in my opinion, than tactical. You need to know your game really well, and if you do that, buy low, sell high, buy low, sell high, and on a constant basis, and you're able to do it well, it can create far better returns than anything. But I think it's far difficult to follow this approach even as a full-time investor. Very, very difficult for retail investors, in my opinion. I think there is a deviation or a kind of modification of it, which industry in mutual fund allows you in form of balanced advantage fund or dynamic asset allocation.
Right. Quickly, in the end, let's talk about dynamic asset allocation and insured asset allocation.
Yeah, so what happens is in dynamic asset allocation, you are not really being very, very strategic, or you're not becoming tactical, you're not becoming constant. You are responding to markets and data in a very structured manner. And a lot of balance advantage funds do that. In fact, ET Money has a service called ET Money Genius, which does that really well over long periods of time. So what dynamic asset allocation does is it takes into account multiple market factors like valuations, interest rates, maybe sometimes domestic retail participation, sometimes inflation data, even market trends on short term and long term, and basically look at combining one or more or three or a few factors and build a model, a kind of quantitative model, and how your equity, debt, gold allocation gets governed. And it may exhibit buy low, sell high strategies. It may exhibit buy high, sell higher strategies, and not buy every low, but buy low when it is ultra cheap in terms of valuations. So it depends what kind of model you are following as a fund manager or as an advisor. Typically, retail investors may not be able to follow the strategies. What happens is these strategies are proven to give you lower volatility in the portfolio. So what happens when there is lower volatility in the portfolio? Your drawdowns go down. When markets correct sharply, you don't see that kind of a correction in the portfolio. So your confidence in an investor goes up, and you are able to give more time to your investments. And again, it comes to the same old principle of giving time to your portfolio. If you give time to your portfolio,
Right.
compounding follows. And I think strategic asset allocation and dynamic asset allocation, one of the fundamental ways one can achieve that in a very meaningful way.
Sure. So
Just that
this was
strategy can be done by your own.
right. So this was all about asset allocation and a way to ensure that your portfolio performs well in different market conditions. Thank you so much, Santosh, for joining in today.